Hi, Abby. It's good to see you. We have an important discussion today. We are talking about Silicon Valley Bank and the markets. Thank you for making time because I know you're very busy, but I know it was also important to you to communicate with clients because it's understandable if we're feeling anxious right now. So
Mhm.
let's talk about what the Fed is doing right now, working to stem a US banking crisis. And let's talk about what is most important for your clients right now. What do they need to know?
So the main question is how are my clients being affected,
Right.
or are they going to be affected? How does this impact each of us individually? And so the first thing that we want to talk about is the difference between the investment accounts that are at the big custodians like TD Ameritrade, Schwab, those type companies, and then the deposit accounts that are at maybe even the same institutions, but the bank side of that,
Mhm.
or Wells Fargo, those type banks. So what we want to make sure everybody understands is that when you have a deposit account at a bank, that is what is under the FDIC protection, so up to $250,000. That goes against the bank's balance sheet. So essentially, it becomes a liability for the bank. That's why it has that insurance. That's why it's protected. That's what's being impacted right now for the clients of the two banks that have gone under, the deposit accounts. The investment accounts are in a segregated account at the like Schwab, for example. So they have the bank part of their business, and then the investment accounts are completely separate. They're kept on completely separate books, if you will, and have completely different ways of working. So
Right.
the investment side of things is not affected at all by liquidity issues at banks. So there's no concern there as far as the investment accounts. The deposit accounts, so CDs, bank accounts, high yield savings accounts, that's what that's what we're talking about today.
Right. So your clients at Reed Financial, their money is kept in segregated accounts in those big, big banks, right?
Correct. So for us, TD Ameritrade, Fidelity, those type companies, they're completely separate from the balance sheet of the bank. So like TD has a bank as well, but that's completely separate from the investments that we hold at TD Ameritrade Institutional, one of
Right.
the custodians that we use. So completely separate. Um, completely segregated account, and safe from what's going on and what we're seeing happen at the two banks so far that we've seen go under.
Okay. So I think the next logical follow-up question, you mentioned it. What if I have more than $250,000 in the bank, which is, and those are the deposit banks that you're mentioning, because that is the max amount that the FDIC will insure.
Correct. So, right. So if you have, and it gets a little bit confusing. If you have, say, whatever, 300,000 at a particular bank that's in your name, 250 of that is insured by the FDIC. And then if it's 300,000 in this instance, 50 of that would be what's called an uninsured deposit. If you have that much cash in one of these deposit accounts, so CDs, high yield savings accounts, um, bank, just a regular bank account, savings accounts. I think I said that. It's a really good time to take a look at that and just diversify a little bit. So right now is also a good time to do some rate shopping. There's some high yield savings accounts out there that have, almost a 4% rate right now. So maybe you can get a higher rate while you're at it. The government has come out and said that they're going to make sure that all depositors of these banks, and any additional banks that have some issues are going to be made whole.
Hmm.
Uninsured deposits as well as obviously insured deposits. So
Hmm.
while they have already said that, you might as well go and make sure that it's under the 250,000 at each bank, just for peace of mind alone, because you're under that FDIC limit. That's what we recommend. That's what we've always recommended. It's a little bit of a hassle. There's that hassle factor to it. But I know our clients prefer to just know that those safeguards are in place, and in case some additional banks continue to have some issues.
Right. So I think a lot of people too want to know how this compares to the 2008 financial and banking crisis.
Yeah, and that's a really valid concern, and it does kind of start to seem like, are we going down the same route? Is it going to be the same effect that we had in 2008? Probably all remember the domino effect of that. And so there's some key differences between what has happened so far with these two banks and what happened in 2008. So after 2008 happened, and we saw huge banks fail that had a domino effect, not just in the United States, but also globally, there were additional regulations put into place, rightfully so. So those additional regulations apply to banks that are known as globally important, basically. So if it's a globally important bank, meaning if its failure would ripple throughout the entire world, then you're going to have some additional regulations put in place. So the two banks that have gone over under Silicon Valley Bank as well as Signature Bank, they were not globally important institutions. So they operated under a different set of regulations. That will most likely change now because of what has happened. But those two banks alone, in the eyes of the regulations, would not have the far-reaching effect as one of these much larger banks and institutions. So what does that mean? That means that the cause of the failure of these two banks, because of the additional regulations on the bigger banks, the more important banks, they can't have the same balance sheet issues that these other two banks have.
Okay. So, Abby, then what are you watching for next? What do you expect to happen?
So what we expect to happen, we're recording this on the 14th, so that's Tuesday. Obviously, a much different day already so far than it was yesterday. So bank stocks across the board, even the ones that, the solid ones like Schwab, all of them got absolutely crushed yesterday, and understandably so, because the news came out of this on Friday. So everybody had the weekend to try and figure out how it was going to impact everything, how the markets were going to be impacted. And then Monday, there was a little bit of maybe an overreaction, a lot of panic selling, and then things have started to go back to normal. Investors are seeing, okay, the government's going to make sure everybody is made whole. So things are a little bit different now. Bank stocks are going back to normal. What we anticipate is continued headlines of the fallout from this. These regional banks that operate under a different set of regulations, some more of them might have the same issues that these other two banks have had. So we're keeping an eye on that, seeing if any additional banks go under, then the FDIC has to step in and take over those banks. That will cause some volatility in the short term, at least, for both stocks as well as bonds. Those are typically more short-term volatility events based on headlines. And then another thing that we're watching is all of this really was caused by historically low interest rates back in 2020 and then rapidly rising interest rates for the last couple of years. So what we're anticipating or what we're expecting to happen is the Fed was set to raise interest rates pretty shortly. They're either most likely not going to raise interest rates like we anticipated before this happened, or they're going to raise them by a lot less than they originally were going to, which is actually a good thing for both the stock and bond market. It allows everybody to have a little bit of a breather, and they probably don't want to rock the boat anymore at this point in time. They're kind of dealing with enough. And so that changes things a little bit. So we're going to keep an eye on that as well, make any adjustments to our clients' portfolios that we need to, as we always do, and continue to keep an eye on the situation as it unfolds.
Okay, more bumps in the road expected. Abby, thank you so much for taking the time to talk this through with me. I do feel better after talking to you.